All right, we're just going to give it a minute while people join, and then we'll go ahead and get started. All right, I see everyone filling in now. So I'd like to welcome everybody. Good afternoon and welcome to our Q4 2024 Financial Markets and Portfolio Update webinar. We're glad to have you with us for this session led by our Chief Investment Officer, Steve Galley. As always, we encourage your questions throughout the webinar, so feel free to drop them in the chat and we will address them at the end of the session. As always, I know we have a lot of ground to cover and Steve has valuable insights to share. So with that, I'm pleased to hand it over to Steve Galley.
Thank you, Katie. And thanks everyone for joining. I know we have a lot of people registered. I think that's great. And I think we have some guests also registered today. So welcome. I hope you find this informative. We're going to try and keep this to a half hour or less. So let's get right into it. There's lots to talk about. You know, as usual, we're going to talk a little bit about what's going on in the markets. I do think this is pretty timely, you know, based upon what just occurred with the election. And then we'll talk about what that means for portfolios. So before I get into some of the headlines, and I always like to take a look at a lot of the headlines, I did also want to take a step back and say, to all of you out there, thanks very much for your trust and confidence in us. We really appreciate that. We take that very seriously. We're always trying to do better. So by all means, please let us know. We love feedback. Anything you'd like us to be doing better, especially on these webinars, let us know. So really appreciate it. So with that, you know, obviously there's been, you know, I was actually curious as to whether we would even know who would be in the Oval Office by the time I gave this webinar, but that actually proved to be very quick. And as it looks like right now, it does look like there will be a full red sweep of not just the Senate, but also the House. So obviously a lot of the headlines are surrounding, you know, what that means, what the impacts are. You know, this headline referencing how, you know, Jerome Powell as the head of the Federal Reserve, you know, potentially coming under pressure by Trump and his administration to lower rates faster. You know, I think that's certainly not going to happen. I think Powell is incredibly smart and well-spoken. So, and you have, you know, the talk of what's going to happen to the courts. You have the bond market having some interesting messages that it's sending in terms of interest rates. And of course, you have stocks basically at all-time highs as we speak. So let's get right into it, you know, in terms of what are the things that I think are really important to pay attention to, certainly in this quarter and beyond. You know, obviously the equity markets are pretty excited. The S&P 500, you know, hit an all-time high on November 11th, and it crossed the 6,000 threshold for the first time. And the Nasdaq Composite Index also hit an all-time high. And look, it's pretty obvious why the stock market is excited. You know, less regulation, more U.S. protectionism, and perhaps most importantly, lower potential taxes. That's really usually good for company profits. And as we know, what does the market care most about? It's the future earnings of all the companies that make up the market, right? And all those things usually can be a boost to company earnings, which is one of the reasons that why markets are at the levels they are. And there's no reason that optimism probably won't continue in the short term. Now, it is now probably certain at this point that a GOP trifecta has occurred. And what does that mean? Well, expectations are that Trump will use his executive power to deregulate across the board. Exactly how that plays out remains to be seen, but we've already seen certain sectors benefit from those expectations, for example, like energy. And of course, US protectionism also can help US companies at the expense of their international competitors. We've seen small caps rally strongly as a result of that because small cap stocks actually tend to benefit the most from protectionist tariffs. And then, of course, we have the future of taxes. Now, we know that in Trump's first term, that he enacted a series of tax cuts that they were basically going to expire at the end of next year. Now the expectation is that they will be extended beyond next year. And, you know, that just won't include tax cuts on individual income, but also potentially on Social Security income, maybe on the corporate tax rate, right? And maybe even on things like overtime pay, as well as tips and gratuities. Now, supposedly all this could be paid for by slashing government spending. And there are some headlines out there about, you know, Elon Musk being chosen to form a government efficiency division to take an axe to inefficient government spending. You know, that remains to be seen, but certainly that's going to be almost impossible to achieve because there's just not that much that can be cut to make up for the deficits that we're experiencing now. And that's actually one of the reasons that, unlike the equity market, the bond market has reacted fairly negatively as a result of the expectation that a lot of what's being talked about in terms of tax cuts and tariffs, that's usually negative from an interest rate perspective because those things can be inflationary. They can drive our budget deficit higher. And that is what the bond market doesn't like, right? In the bond market, there's one thing it hates more than anything, it's inflation. And so we've seen bond yields come up substantially. So the bond market is saying, we're going to be our own enforcers if there are things that we don't like in terms of what this administration is going to do. So even though the Fed last week cut interest rates again, yields have gone up. Mortgage rates actually have gone up. So the other thing to really keep in mind is that the background in terms of this country's financial position, as well as our economic backdrop today, is very different than it was in 2016 during Trump's first term. So as an example, in 2016, inflation was low. It was very comfortably at the Fed's target rate, which was basically around 2%. That is not the case today. Inflation, although it has come down, remains uncomfortably well above the Fed's target rate. And interest rates back in 2016 were much, much lower than they are today. The 10-year Treasury bonds, as an example, in November of 2016 was trading at about 1.75%. Today, it's trading, you know, upwards of 4.25%. Very different. Also, our net debt back in 2016 was 80% of our gross domestic product. And now it is getting ready to blow through 100% of our GDP. And that's a level we haven't seen since the rebuilding phase that this country went through in post-World War II. So therefore, Trump and his ability to enact a lot of these massive changes that are being talked about is I would say, much more constrained as a result of this different economic and financial backdrop that we find ourselves in today than where we were in 2016. So longer term, you know, it's really hard to tell what all this is going to mean for the market. You know, larger deficits could be a problem. Tariffs usually are just like an extra tax. That's never good for economic growth, not just for this country, but globally. And we also don't know what's going to happen with, you know, foreign policy. I mean, you know, there's potentially good or bad results that could come about from a more aggressive foreign policy stance, which is a lot of what's being talked about. And if there's one thing that we can be confident in, I don't think Donald Trump really takes to being slighted in any way kindly. And as we know, actually, the country of Iran was conducting an attempted assassination attempt against him. I don't see him taking too kindly to that. So that we don't know how that's going to play out in terms of what's going to happen with the Middle East and how that's going to be addressed moving forward. So all these things are playing out. Certainly, some people are anxious and nervous over a lot of these changes. And certainly, though, the market has, at least the stock market, has voted with a big positive. Now, as I was talking about, when you look at our U.S. condition today in terms of its finances, right, and the graph here is showing total government spending on an annual basis. You know, we're looking at almost $7 trillion. And then you're looking at our deficit, which is close to $2 trillion. Now, assuming that you really can't cut much from the Social Security blue bar here or the Medicaid and Medicare bar, which is a huge chunk of what our federal budget is, and probably, you know, if anything, you want to spend more on defense, and that's certainly what the administration's been talking about, there's not that much left you can cut from in terms of discretionary spending or non-defense spending. So that's why it's going to be very hard to pull off a lot of what's being talked about. And when we look at our net debt as a percent of our gross domestic product, this lower right-hand chart, you can see where things are expected to be going. And if I blow that up into in this page right here, you know, this is the highest we ever were, was just above 100% of our GDP in terms of our debt post-World War II. We have never been there since then, but it's being projected that we will go there. And that's something, again, that the bond market doesn't like. And certainly higher debt ultimately in the long term usually means higher taxes, not lower taxes. So, you know, whenever we talk about spending, I always, anyone who likes economics out there, you know, that's an image of Milton Friedman, one of my economic idols. And, you know, to paraphrase Milton Friedman, there's really 4 ways you can spend money, right? You can spend your own money on yourself. You can spend your own money on someone else. You can spend someone else's money on yourself. Or finally, you can spend someone else's money on someone else. So when you spend your own money, whether on yourself or someone else, you tend to care about it. You're pretty judicious about how you spend that money. But when you spend someone else's money, especially on someone else, you don't really care how much you spend or what you get for it. And that is one of the reasons why there's been a lot of talk about the inefficiency of government spending, because in a nutshell, the government is basically spending someone else's money on someone else. So, you know, to the extent that that can be reined in, I'm all for that, but I think that's going to be really difficult to pull off. And, you know, it also comes down to the tax debate of, as much as everyone hates to pay taxes, and I'm certainly one of them, can we really afford to cut individual tax rates very much? Because if you look at the history of our tax rates, right, and the orange line is the history of the individual income tax rate, and the blue line is the history of the capital gains tax rate. And as you can see, maybe I can invoke my laser pointer here. We have not been much higher than these levels in a long time. As a matter of fact, on average, tax rates have been a lot higher. So how much lower can we really go? Because the lower we go, of course, that's just going to put a lot more pressure on that budget deficit. So as much as we'd like to think that it would be really nice to lower these rates even further, looking at historical perspective, I'm a bit skeptical about that. Now, as I was talking about, the bond market is also making noises about not being happy about what's being discussed in terms of a ballooning budget deficit. So back in 2016, what did we have? We had a nice, normal, upward sloping yield curve, right? Now, it wasn't that nice because interest rates were super low. I mean, if you bought a 1-year T-bill back in 2016, you were barely getting over 0.5 of 1%. If you bought a 10-year Treasury bond, you weren't even getting 2%. So if you loaned your money to the government for 10 years, they weren't even paying you 2% a year in interest for that loan. But at least interest rates were low, which gave that administration a lot more flexibility. Not so today. So this chart is really what the yield curve looks like today and basically at the beginning of October. So the red line is where interest rates were at the start of October. And the blue line is where interest rates were about a week ago. And as you can see, interest rates came up dramatically over the past month. And I always say that the bond traders are the smartest guys in the room. And in this case, the bond market was speaking even before the election, saying, we're expecting higher deficits and potentially higher inflation. We don't like that. We're pushing interest rates higher. And that's really exactly what played out. And interest rates are a lot higher than they were back in 2016. Now, on a one-year Treasury bill, you're getting well over 4.2%. And on the 10-year Treasury bond, you're almost getting the same, 4.2%, because the yield curve is now somewhat inverted. And as we talked about, an inverted yield curve has always correctly predicted a recession, although maybe this time's different because the yield curve does seem to a certain extent to be de-inverting a bit, right? And it's not hard to imagine that at some point, maybe the yield curve looks a lot more normal and starts to, here, I'm going to use my, my pen here, starts to get back to a normal upward sloping curve, right? Where the short end here comes down and then we have a normal upward sloping curve going like this, which would mean that short-term rates will come down. And as expected, the Fed is expected to cut short-term rates, not just one more time this year, but also several times early next year. But as we were saying, let's take a look at what's happened year to date. This actually shows what various sectors of the equity markets have done, as well as the bond markets year to date. And everyone knows I'm kind of a movie buff. I'm going to invoke the infamous Jeff Spicoli from Fast Times at Ridgemont High, but market returns this year really have been totally awesome. You know, it's been all about growth stocks. The S&P 500 growth sector is up almost 35% year to date. The NASDAQ up 25% year to date. It doesn't really matter where you were invested, you've done pretty well. Now, as I was saying though, bonds, on the other hand, in the last few weeks, negative, right? Because when interest rates go up, bond prices go down. So, sometimes I do think it's time to take a step back and, you know, say, thank you, Mr. Stock Market. Never a bad idea to take some profits. You know, most likely, many of you, your equity exposure is more than it was at the start of this year. So never a bad thing to rebalance and kind of get back to kind of the allocation that you want to be at, given your risk profile. The other thing I'll mention that's been really interesting that happened was, you know, small cap stocks have done really well in the last few months. Actually, they've done better than almost any other sector. And, you know, one of the reasons behind that is protectionism, right? Protectionism and lowered interest rates. So if you think about it, one of the reasons why the S&P 500 and the NASDAQ have hit all-time highs, the small cap index, as measured by the Russell 2000, it hasn't hit an all-time high since 2021. The last time the Russell 2000 was at an all-time high was on November 11th, 2021. So it's been 3 years since we've had an all-time high in small caps. And maybe we're finally going to see small caps catch up. And certainly they've been trying to do that. And really, what's the simple reason behind that? Well, the simple reason is, what was the Fed doing starting in 2022? They were raising interest rates. Small companies need access to debt to grow. They need easy access to debt to grow. And when the Fed was aggressively raising interest rates in 2022, and the early part of 2023, that hurt the ability of small companies to raise debt. So that's one of the reasons why the Russell 2000 is yet lagged, but it's also been important to have exposure now to small cap stocks as they have been catching up, as the Fed is cutting rates, and as talk of US protectionism will potentially disproportionately help small cap stocks. So everyone knows I love to take a look at this slide. This kind of looks at where we were in terms of a valuation perspective on the S&P 500 a year ago. So this tells us that a year ago, the S&P 500 was trading at a level of about 18 times forward earnings. That was a little expensive, but not too much out of line of the 25-year average of right around 17 times earnings. But today, different story. We are now in what I would consider to be nosebleed territory. Equities are expensive on a valuation basis. For every dollar of earnings that you are buying when you buy a company's stock, you are paying over 22 times that dollar when you're buying a company's earnings. That's expensive. Now, a recent report I just read by Goldman Sachs, they expect earnings will be the primary driver of forward equity returns. In the third quarter, the S&P 500 third quarter profits grew 8% year over year. That's pretty good. That was actually a lot better than what was expected. I think the expectations were around 3%. Goldman's forecasting earnings next year to grow by 11%. So if that plays out, perhaps that multiple that we're looking at is justified. But again, we haven't really been this high, or we haven't been higher than this since when the dot-com bubble burst, when we were paying 24 times forward earnings. That always makes me a little nervous. We also look at other research. We also look at Bank Credit Analyst Research, or BCA Research, which I think is a great publication. They think that the stock market right now is 56% overvalued. But interestingly enough, you have to keep in mind that a lot of this is driven by the fact that there is heavy concentration in the stock market. Right now, the top 10 stocks are a huge percentage of the overall market cap of the index overall. As a matter of fact, the top 10 stocks make up over 1/3 of the entire market cap, right? And so when you think about that, a more nuanced picture emerges as to how expensive the market is. Because if you take out the top 10 stocks, then the forward PE of the index is closer to about 18 to 19 times, not the 22 plus times. So in general, that means that the rest of the market, besides those top 10, are not terribly overvalued. So that is somewhat of a source of comfort. Now, the Fed, when they were talking about what they're looking at moving forward, they seem to be less worried about inflation, as this blue line is showing, because it's come down, versus unemployment, which has kind of crept up. So the Fed is now going to pay attention to unemployment, which I think is smart, because as we talked about, unemployment is, to me, what the bigger risk is to our economy. Because if people start getting laid off, if it's harder to find jobs, that means the consumer can't spend, and that's trouble, right? That's trouble for company profits, and that's trouble for the market. So that seems to be where their focus has shifted, although depending on what happens with all this talk of tariffs, tax cuts and whatnot, inflation could still be a problem. So that's going to be an interesting conundrum the Fed is going to have to deal with, which is why they always talk about being, quote unquote, data dependent. They are going to have to pay close attention to what happens with the new administration policies, because if they do become inflationary, then maybe the Fed isn't going to cut rates much at all, right? So something really important to pay attention to. However, one thing that's happened over the last 3 years is that it's been really easy for people to make money keeping money on the sidelines, right? So this chart is telling us that the outstanding balance in money market funds, which is, super safe short-term investments, has boomed and is now at a record level of over $6.5 trillion. Now, what is going to happen with that money if we see a dark market downturn? A lot of that money is going to say, I've been waiting for that market dip for 2 years. Let's invest, right? And so that to me is a nice cushion or buffer to any market volatility or downside movement we might see, because we do have a lot of cash sitting on the sidelines. And by the way, the cash is making around 4% because of that inverted yield curve. Short-term rates are really high. So it's not even that painful to be sitting in cash, whereas a few years ago, if you were sitting in cash, you were making nothing. So that cash has been very patient, waiting for its moment to dive in if the markets dip. So that's one, nice mitigating factor that we will see, I think, if we do have market volatility moving forward. The other thing to think about too is that in general, global interest rate policy has been pretty good. So basically what this chart is showing is, in general, all the central banks of the world, the G10 central banks, whether they've been in a hiking mode or a cutting mode. And as you can see, we have just emerged from where they were all in a hiking mode to where they are now all beginning a cutting mode, just like our Federal Reserve is. That does tend to be stimulatory for the global economy. I mean, since Switzerland's national bank cut rates in March of this year, 10 out of the 11 top central banks have started cutting rates. That's the most coordinated rate cuts we've seen since 2009, which is, after the great financial crisis. Those countries represent almost half of all global GDP. So that's why that is pretty stimulative. So that's one of the reasons that, we're also somewhat comfortable with where the markets are. So what does all this mean for portfolios and strategy? Well, overall, we're going to stay neutral on our equity exposure. We don't want to go underweight because, again, there could be some short-term optimism about what's going to happen with tax rates and whatnot. But we do want to favor the U.S. versus international stocks. I mean, at the end of the day, tariffs and protectionism will disproportionately favor U.S. stocks over international ones. We have to assume that international earnings will be hit a bit as a result of those tariffs. We also think it's important to have a little bit of alternative exposure, right? So not necessarily adding to bonds, which, as we know, might be under pressure because of rising interest rates, but more importantly to things that act differently than traditional equity or fixed income exposure, which would be potentially gold and maybe infrastructure in terms of maybe real estate infrastructure, which we still think is a good place to be because of all the spending that is continuing on building out this country's infrastructure, which is in bad shape as it is. In terms of what we're thinking about in terms of fixed income, we had been overweight fixed income. Everyone has heard me, I think, say many times that bonds are a pretty good place to be, given the fact that you're getting nice coupons now. A few years ago, coupons were incredibly low. That's not the case anymore. That being said, we don't want to be overweight, given the fact that we're unsure where policies are going to go in terms of tariffs, protectionism, deficits. So we think it's smart to actually reduce kind of what we would call core fixed income, which would be government and high-grade investment corporate bonds, but also look at being a little more creative and investing in what I would call more strategic income exposure, where there's a little more flexibility to get more value, even if inflation creeps up. So that's what we're thinking in terms of the portfolios, and many of you may have seen a lot of trades happen already in your portfolios. We are executing those trades this week. But that, we get to the half-hour mark. A lot of information, a lot of talking, but how about some questions for if anyone's got some out there?
Great, thank you, Steve. As Steve mentioned, if you guys have questions, please put them in the chat. We do have one for you. Someone said, I've heard that the US dollar has rallied recently, possibly due to the election results. Could you explain what's happening there?
Yeah, sure. I mean, and there was a well-received op-ed piece in the Journal the other day that basically said the dollar loves Trump. I don't know if I'd go that far, but one of the reasons that you've seen the dollar rally is because anytime you have a situation where the administration is talking about protectionism and tariffs, that's gonna benefit the currency, certainly in the short term. So the dollar has rallied as a result of that chatter. I think longer term, that's going to be a tough call. I mean, the longer term, the dollar is, depending on what currency you're looking at, it is relatively overvalued, certainly against the euro, certainly against the yen. A bunch of friends of mine who recently went to Japan were amazed at how much, or I should say, how little they had to spend in yen to buy, a nice meal because of that dollar strength translating into great travel conditions for many of us abroad. That longer term, I think there's a big question mark about that. But certainly in the short term, that U.S. exceptionalism has played out in terms of a stronger dollar.
Thanks, Steve. Another question for you. In our current economy, what should our annual YTD or year-to-date goal be?
So just to clarify, was that question in it? What, can you repeat that question again, Katie?
Yes, in our current economy, what should our annual year-to-date goal be?
Well, if we're talking about economic growth, right? The long-term trend of this country's economic growth is around 2% a year. And a lot of people expected that to slow down dramatically this year, and it didn't. And I think a lot of that has to do with the surprising resilience of the U.S. consumer. Everyone was talking about how the pandemic savings are gone, and how the savings rate is much lower, and how inflation has impacted consumers' ability to spend, and that they have to pull back and start increasing their savings to make up for the depletion of all those pandemic savings. But the consumer is still showing a lot of strength. And a lot of that is driven actually by what I would call the higher end consumer, who has benefited disproportionately by this great market situation. A lot of people have a lot more discretionary income because their portfolios have done really well, and so have their home prices. And as we know, there's still a supply and demand imbalance in the U.S. housing market. So even though mortgage rates are, somewhat punitively high, home prices are also very high because of that supply-demand imbalance. So between housing values being strong and portfolios being strong, the consumer has a lot of spending power, and that's played out, right? And that's really padded company profits. So growth has been surprised to the upside as a result of that. And so you don't really hear much talk about recession anymore. That makes me a little nervous, by the way, but yeah, it's economic growth this year has trended actually well above 2%. We'll see how the year ends up, but probably will end up being closer to 3%. Next year, I mean, even if we do a little less than that, I think that would be just fine in terms of an economic growth. In terms of a market return expectation, I think that's a little more difficult, of course, to predict, and no one can, but I do think it's reasonable to expect much lower equity market returns moving forward, in the sense that we've just come off a couple of great years in the market. I mean, literally if this year holds out, 2 years of over 20% returns in the equity markets. That's rare. And that sets the bar. If you're starting at a much higher position to start next year, it's a lot harder to achieve that type of growth in the equity market again. So I think single-digit returns in the equity market next year would be a big win.
Thank you, Steve. One more question for you. Do you see the unemployment rate drastically changing under the new administration?
I do think that there's also been a lot of talk about immigration policy and what we're going to do as a country with undocumented immigrants. Because that has had a big impact on our labor market. So it's a little early to tell what type of impact that will have on the labor market moving forward. But as I've always said, once the unemployment rate starts moving up, it tends not to stop. And it did start to move up fairly significantly in the last couple of quarters, triggering a couple of famous economic metrics that say that a recession is inevitable once the unemployment rate moves up over 0.5% off its low point, which it did do this year. But again, those rules are just rules. That doesn't mean they're going to hold true moving forward. They've held true in the past, but and so it's been a mixed picture because the unemployment rate is still historically low when you look at history. I mean, it's still below 5%. I think the real question is if it creeps up, if it starts to creep up again and gets above 5%, and then it tends to, if it keeps going towards 6%, that's when you're going to have some problems, right? Because that's when the consumer will not be able to spend as much. But it's a mixed bag because again, the consumer has been strong. It seems as though people who want to be employed are employed. I mean, there's been layoffs in tech and in finance here or there, but not to the extent that the unemployment rate has moved up actually as fast as some pessimists have thought. So, again, hard to know, but right now the unemployment rate's still low. And then now that the Fed, as we mentioned, is paying attention to that because some of those forward-looking metrics have ticked up. And if the Fed is cutting rates, that tends to be pretty good for the employment market. So, I'm less worried about it than I was in the last few quarters.
Great. All right, we have one more question and then we will call it. Someone asked, if we see a market correction in the near future, should we reallocate the equity and wait for a better entry point? Let me know if you
Good
need to repeat.
question. I mean, look, I think you should reallocate right now. I mean, I think a lot of you probably have more equity exposure than you did at the start of the year, and certainly that you did at the start of 2023. So why not, shift around a bit, take some profits. I mean, of course, that usually means if it's a taxable account, you're going to have to pay some gains. That's not the worst thing in the world. As my great uncle always said, no one ever went broke taking a profit. And again, coming in to bonds at this point, investment grade corporate bonds in general are paying a healthy 5-ish% coupon. And depending on, what the bond is, sometimes a lot higher than that. So that's not a bad place to be, especially if you expect market volatility, for the next few quarters. But again, if there is a market downturn, certainly that's not a bad idea to invest. If you have cash on the sidelines, which as we saw, apparently a lot of investors do, that's certainly not a bad time to buy in. And I always get this question from my friends about, well, what exactly, how much cash should I have? And I always say it's a question of degree, meaning, you never want to be all in terms of the equity market or all out, right? But if, for example, let's say you have about 80% stocks and 20% bonds, but now that's gotten up to 85. Well, reorient, maybe get back to that 80-20. And also if you feel like the market might be a little overvalued, which it certainly is, and if you do put more cash on the sidelines, let's say you have 10% cash sitting on the sidelines. If we see a market downturn of 5%, great. Maybe put a quarter of that cash to work. The market goes down another 5%, put more of the cash to work. If the market really takes a big dive and goes down 15, 20%, never a bad time to put all of that cash to work because then you're buying when things are at least on sale or a lot more reasonably expensive. So that's, never a bad idea to follow. But again, market timing is very difficult. But that is always something to consider in terms of just trying to be smart about the inevitable market gyrations that we will see. The problem is that we really haven't had a downturn in almost 2 years. I mean, we had a little blip this summer, but that lasted for all of like 3 or 4 days. So, again, it's, as I always say, it's not timing the market. It's really time in the market. And, for anyone who's nervous, as we know, the longer your time horizon is, the better you are, because even if you invested at the worst possible time in history in the stock market, you still made money 10 years later, because the market overall chugs upwards inexorably over time.
Answer. Okay, well, that wraps up our Q&A section of today. I just want to thank everyone for joining us and remind you that I will be sending out the recording. So in about a week or so, you will be getting a recording of today's session. So keep an eye out, and we appreciate your time and your participation. So thank you again. We look forward to connecting next year. And Steve, if you have any closing remarks.
Nope. Thanks, Katie. And thanks everyone for joining. Until next time, I hope it was informative and we look forward to your feedback.
Thanks. Have a great rest of your day. Bye-bye.